Oh, we live? Yeah, look like we live. Hey man, what's up with y'all? It's Friday. How y'all doing? Friday, 5 o'clock, stock market live. All right, we do this every week. I love you guys. I appreciate y'all for continuing to tap in with me, continue to support the channel. We are live on Facebook as well as YouTube. Hit the like button, subscribe to the channel, right? Leave me a comment, and we're gonna get into it, right? So we're not gonna waste any time. It's Friday. I don't want to waste y'all time. What y'all doing with y'all money today? I got paid. What y'all doing with y'all money today on Friday? Make sure that y'all putting some money into the stock market. We're gonna talk all things stock market today. Make sure y'all continue to invest in the things that y'all love. We talked about the 3 to 5 great companies that you love. Continue to invest, invest, invest. All right, so a whole new week has went by. Right, last week we talked about volatility in the market. We had some red days last week. We had some volatility last week. This week has been a little volatile also, but we have now hit an all-time high in the stock market. We got multiple stocks at all-time highs. We got the S&P 500 hitting a 52-week high today, right? And we're gonna explain why. All right, before we get into that, let's look at the charts as we always do. Let's take a look at the charts. Um, and as you can see right now, right, this is a 3-month chart when it comes to the S&P 500. We see all the way on the right, we have a new all-time high right here. And then we're looking at the SPY when it comes to the S&P 500. And we hit a new all-time high during the day. We closed at 677.25. It went all the way up to 678.47 earlier this afternoon. But we did reach a new all-time high based on a report that we're going to go over today in the market, right? So regardless of the volatility that comes in the market, it's always important to invest and hold long term. Everything that we speak about here on the Financial Blueprint channel is about long term investing. So if you are a newbie, right, if you're new to the channel, new to investing, always consider long term investing as the most important aspect of your investing journey. Right, we can talk about option trading, we can talk about futures, we can do things like that, but the most important thing is buying the 3 great companies that you love and accumulating as many shares as possible, as well as 2 ETFs, and allowing those things to make you money over a long period of time. Right, so as you can see right now from this chart, the S&P 500 has reached an all-time high today, and it's going to go higher, and it's going to go higher. All right, so before we continue with the market, all right, we are currently in a government shutdown, as you know. I believe today was day 24, which is, has caused a lot of problems. And we have benefits that will be ending. Federal benefits are ending as of November the 1st. So it's important that we have a level of understanding, but also some, people out here really struggling when it comes to federal workers, some military, people have to go to work and not get paid. Some people are furloughed. A lot of people are furloughed and not getting paid. Right. So right now it is a trying time as we get closer and closer to the holiday season. Reach out to somebody that that works for the government that might be furloughed or even possibly working right now for free. Check in with them, see how they doing. Right, this is a tough time when it comes to government workers, as well as everything that's getting impacted by government programs. So it's not just furlough workers; it's also government programs. It's also people that's on the extended level, contracting work and everything that we got going on. So we are going to take a look at the most recent interview by the House Minority Democratic leader, Hakeem Jeffries, and all things what he has to say about the current state of why we have not received, at minimum, a CR, and why we currently are still in a tough situation for the shutdown purposes, and how things are going to get worse over the next 7 days.
Just on the government shutdown now in its 24th day. Joining us right now is House Minority Leader Hakeem Jeffries of New York. Leader, thank you for being with us this morning. I think the big question is, how do we get out of this?
That's an important question, and we continue to maintain that we will sit down with our Republican colleagues anytime, any place, here at the Capitol, or go back to the White House to enact a bipartisan spending agreement that actually meets the needs of the American people, improves their quality of life, lowers costs in an environment where inflation continues to move in the wrong direction. And we also need to decisively address the Republican healthcare crisis that is crushing people all across the country, particularly now that tens of millions of people are receiving notices that their healthcare premiums are about to skyrocket.
There was an op-ed in Roll Call recently that was pretty interesting on this. It said what you are asking the Republicans to do right now when they control the White House, the Senate, and the House is effectively what the Democrats could not do when they controlled all three of those heads of government themselves. The 10-year setup for this, for these, or the 3-year setup for the expiration of these credits was intentionally put in. It was put in when you controlled the White House, the House, and the Senate. You couldn't get it passed for longer. And so this is a setup that kind of your own creation that you all couldn't extend beyond that. Now you want the Republicans to do something you didn't do when you were in power?
It's not a setup beyond what we could do. We extended the Affordable Care Act tax credits in 2022 for 3 years. The program is working. It's providing health care to tens of millions of people in an affordable way, and it should be continued. It's interesting to us that Republicans decided that they would prefer to permanently extend massive tax breaks for their billionaire donors in their one big ugly bill, which also at the same time dramatically increased the debt and enacted the largest cut to Medicaid in American history, but refused to consider extending Affordable Care Act tax credits that actually benefit working class Americans, everyday Americans, and middle class Americans. Their priorities are misplaced. And as Democrats, we're going to continue to fight for the American people all across the country, in rural America, urban America, small town America, the heartland of America, and of course, Black and brown communities throughout America, all of whom are being devastated by this Republican healthcare crisis.
Leader Jeffries, we were just joined by Senator James Lankford from Oklahoma. He's a Republican, and his concern with this was that the ACA subsidies aren't helping bring costs down overall. He said that in his state, Oklahoma, if you look over 6 years from 2013 to 2019, premiums for ACA plans were up by 200% versus premiums being up by 29% for commercial plans in his state. His concern is that there's something that needs to be fixed within this. Some of the things he threw out would be things like limiting fraud by just requiring that there be at least a $20 premium or some premium that's put down instead of zero premium so that people get enrolled in things without even knowing that they're enrolled in some of these programs. What do you say to that?
We've made clear in the House that we will consider anything that emerges from the Senate in good faith in a bipartisan way that both reopens the government while at the same time addresses this healthcare crisis and extends the Affordable Care Act tax credits in a meaningful way. The 90% or so of the people who benefit from these Affordable Care Act tax credits make $63,000 per year or less. And a significant number of small businesses and entrepreneurs across the country rely upon the Affordable Care Act tax credits in order to provide health insurance for themselves and for their families. So this is an issue that needs to be addressed. In fact, we know that red state residents actually are disproportionately higher represented in terms of the Affordable Care Act tax credits than any other part of the country. And so we're fighting for the American people here, and hopefully we can find a bipartisan path forward.
It's such a complex issue, Leader. And what we're seeing now with the shutdown, some real effects starting to happen, I guess. And that's where people just separate out all the points that you're making right now about what's wrong with the healthcare system and when and how you fix it. And when you're able to have those discussions and those negotiations. And maybe it shouldn't be done, by shutting using leverage, which shuts the government down, where you don't really have time to do it effectively. This is what Senator Langford, just talking about history, this is what he said when Republicans were going to do it about Obamacare.
Well, in 2013, as folks recall, Republicans were mad about Obamacare. We were pretty clear about it, and we had a big government shutdown. It was shorter than this one. And Democrats at that time said, we will not negotiate on health care while the government is closed. Well, now it's literally the opposite on it, that we're saying we're not going to negotiate on health care. Health care is incredibly complicated. You can't do it while people are not getting SNAP benefits, people are not getting paid, air traffic controllers aren't getting paid. Well, you can't sit there and say, we'll do this little tweak and that's going to be enough. It's not enough. So let's actually have a real conversation about all these issues, but not while there's a shutdown.
And I think it's possible, Leader, that Republicans all feel that way, and we're just going to be stuck here until some really bad things happen.
Yeah, we haven't shut the government down. Donald Trump is the president. Republicans control the House and the Senate. And what we've repeatedly made clear is that we would not support a partisan Republican spending bill that continues to gut the health care of the American people in an environment where Republicans already enacted the largest cut to Medicaid in American history. Hospitals, nursing homes, and community-based health centers are closing because of Republican policies in their one big ugly bill all across the country. Medicare is facing a $536 billion cut at the end of the year unless Congress acts, again connected to the one big ugly bill. And now Republicans are refusing to even consider extending the Affordable Care Act tax credits when open enrollment starts on November 1st. This is a now issue.
But Leader Jeffries, you kind of conflated a spending bill with a clean CR. It's only 24 pages. It keeps the government open at this point. And the House passed it. It's ready to go. The Senate has it. I know that the Republicans control everything, but you know how the filibuster works. And God forbid Republicans, fold on the filibuster, because it'll be used, both parties will use it against the other. It's one of the last safeguards that make the Senate different than the House. And the only reason the Senate can't do it is purely because of Democrats. And you had one of your colleagues in the Senate say, this is the only leverage we have. People are going to get hurt. This is the only leverage we have to get what we want on health care.
So let's just be straightforward. They need 60 votes, right? They need 60 votes, and we reported on this. We have discussed this. This is not the first time we have talked the government shutdown. They need 60 votes to pass a funding bill. They also have an opportunity to approve a CR. The House has, I repeat, as he stated, the House has already pushed it forward to the Senate. The Senate will only need to push it forward for the CR, a continued resolution, to be approved, so that it's a temporary bill, so that they can continue to negotiate and allow the government to come back online. Right? They have done a CR, I believe, 13 or 14 straight times over the last 7 years, right? Consistently, to ensure that the government does not shut down from the previous shutdown, which was in 2019. So this is a leverage tactic, and regardless of how people feel about, different parties and things like that, if you have a 60 vote requirement and 55 current votes and you're awaiting 5 other Democrats, then obviously the Democrats have the power to open the government. Like, it's just simple math. It's not necessarily a political conversation. You don't have to debate on the topic. It's real simple. Hey, if you wanted the government to be open, it would be open. So we can do the politics speech. We can talk about all of the issues and the problems that we might have with each other and things like that. But let's just be honest. We got 850,000 federal workers that's been furloughed. 850,000 federal workers that have been furloughed, and you got a whole bunch of other people that's about to be, SOL when it comes to their SNAP benefits starting on November the 1st, as well as WIC coming shortly after that. So how about we stop playing politics and get it together and ultimately bring this thing together, and we can negotiate and open up the government where people can go back to work and benefits and other things can get back moving, so that we don't have families during the holiday season. Because this is what it's looking like, right? We have families on during the holiday season. People have to go out and get extra jobs. People don't have money to pay their bills. You got federal workers having to touch 401ks and people that gotta tap in and try to get their mortgages pushed back, and zero interest rate loans, temporary loans from the government and from other agencies and banks that might be able to help you out during this time. There are programs available for federal workers as well as military in this time to help. But we gotta stop playing politics and get things moving so that families and holidays can be something that we actually look at as a positive rather than what is very shortly about to happen, which is in about a week or two, some bad times out here. Some bad times out here, right? We have federal workers that already went 30 days without a paycheck. The month of October is over with, right? We got military that possibly will not get paid in about a week, right? They figured out how to get the first $8 billion they need to pay military, but there's no guarantee that the next $8 billion is going to be readily available to pay those soldiers. So again, it's cool to have all of the political speech and to try to save face when it comes to your constituents and your party and all that good stuff. And I'm not criticizing the leader, Hakeem Jeffries, per se. I'm just saying that the United States government got to get it together. Let's just be honest. All right, so we have the government shutdown continue. Again, we have funding, agencies and banks that if you are someone that's right now struggling with your finances, if you are a federal worker and you have been furloughed, or you are a federal worker working right now, not getting paid, I would say use your community, right? Use your community as much as you possibly can. Your loved ones, your people that surround you that could help you out during this time. And we got to get through it, right? We got to get through it. So that is the government shutdown, day 24, right? And it doesn't look like they're going to agree on anything anytime soon. Next week we have programs that ends, and I'm praying that hopefully people can help each other out, right? Reach out if you need any help, and hopefully some people can be there to help you out, right? So right now, we have an update on working class Americans that are investing in the stock market. And I'm so happy to see this, and I'm so happy to see this report. This is why I actually wanted to show it, because this is an amazing report from CBS, where it basically states that working class Americans, not high class, but working class Americans, are investing in the stock market. And let's take a look at what the report has to say.
The report shows that more working class Americans are investing in the stock market. A survey conducted by the BlackRock Foundation and Commonwealth found that 54% of Americans living on low to moderate income, so between $30,000 and $80,000 a year, are putting some of their money in Wall Street. It's the first time a majority of lower earners have an investment account. More than half of those people began investing over the past 5 years. For more on this, Claire Chamberlain and Timothy Flacca join me now here in studio. Claire is the president of the BlackRock Foundation, which works with organizations aiming to elevate low to moderate income households. Timothy is the CEO of Commonwealth, an organization creating systemic change in the financial system. Thank you both so much for being here. And Claire, I want to ask you first, what do you think is contributing to this behavior change? Do you think the perception of risk has evolved? Do you credit investment apps?
So first of all, thank you. We're delighted to be here today. At the BlackRock Foundation, as you pointed out, we really focus on creating pathways for more and more Americans to build financial security over time. And it's one of the primary reasons that we decided to partner with Commonwealth to understand this new group of investors who have come into the markets, particularly in the last 5 years. And
so what we're seeing here is, if you pay attention, right, it says salary of $30,000 to $80,000. 54% of people that make 30 to 80,000 are investing in the stock market. If I had ability to just clap my hands right now, I would definitely do it. And this is just an example of how things have changed, right? There was a time where most people did not have access to the stock market because it wasn't readily available for the average American. Now, because we have the apps, we have the phones, we have the computers, we have the banks and brokerage firms and all of the different things that you can do nowadays, you can, with your phone, invest in the stock market at any time during the trading day, right? And aftermarket trading, 24-hour trading is coming, by the way. I'm not doing that, but it is coming available over the next year or so, right? So there are average low to mid income households are investing, and that is an amazing thing to see. And I always say it don't matter if you got $20, it don't matter if you got $30. Invest. You can buy slices, you can buy shares, slices of shares of stocks now in these apps, and it's so important for you to. Doesn't matter how much money you have. Doesn't matter if it's a little bit. Invest. And I'm proud to see that most, and this is the majority, 54%, the majority, more than half of Americans that make 30 to 80,000 that have investment accounts are investing in the market, and that's a great thing to see.
Certainly, technology has played a part in lowering barriers to entry and making investing more accessible. But one of the things that we're particularly excited about is to study what is happening once people enter the markets, what's their experience, what are their motivations, and with a view towards how can we support their long-term financial success.
So Timothy, maybe you can pick up on that. What are their goals, financial goals?
Yeah, this was something we were just delighted to see in the research, Lindsay. You'll see in the report, it ranges from retirement to saving for one's kids, to saving perhaps for a down payment on a home. And the common thread seems to be that people are really thinking about the long term, which we know historically is how people have been successful in building wealth through capital markets. So we're very pleased to see that pattern. And one thing that was interesting is we found the number one challenge that people reported was that they weren't sure what to invest in. So we think that really is an opportunity to rethink investor education and help people to have the information that they need in order to make investment choices, as Claire said, now that they really are in such record numbers becoming participants in capital markets.
It's kind of interesting because we're seeing on the flip side other data, like it's taking longer for people to save up for a down payment on a home. Maybe some younger people are staying with their parents more often. How do you square those juxtapositions?
Yeah, I can start us there. I think there are many pathways that we've seen for people, regular people, to build wealth in this country. But some of them, as you noted, are getting more difficult, right? I think many of us know how expensive homes are in some of our more competitive real estate markets. There's increasing talk that maybe education isn't the return for everybody that it once was. Probably not all of us are meant to be entrepreneurs. But it turns out that these days, really, there are very low entry barriers to participate in capital markets. And from our perspective, when 54% of the population is doing something, it's time to listen and to repeat, I think, what Claire has said. Ask ourselves, what are the opportunities to support this new cohort of folks so that they are successful and they are able to use this pathway to build wealth for themselves and their kids?
So to start to answer that question, what do you want to leave people with?
Well, we know from history and from results that persistence in investing is what delivers over the long term. Our CEO, Larry Fink, has been quoted as saying, if you were an investor January 1st, 2000, you would have earned a compound annual return of 8% for every single year from 2000 to now. So keeping people invested is a goal. How do you do that? We believe that helping people build emergency savings as an important safety net alongside their investment accounts, we think that's a real opportunity to kind of underscore and lean into.
It's great to see. And let me just give my recommendation to everybody, right? You have to start investing from a long-term perspective first. everything that you think about, I mean, again, if you're 20, if you're 30, if you're 40, if you're 50, it doesn't matter. Ultimately, in the end, we know on average the stock market goes up 8 to 12% a year. And with the rate of inflation and how the cost of goods and services continue to go up, the longer you have money not making you more money on top of itself, you're going to lose value of the dollar consistently on a daily basis. And again, value is most important in this conversation, because we know that the $1 is not worth nearly as much as the $1 did 10 years ago, right? And an easy example of this is in the 90s, for example, going to the movies was cheap. I mean, I remember a time when it was like $5, right? As we know that same movie ticket is now, double that price, if not triple that price, depending on where you are. So the value of the US dollar continues to go down over time due to inflation and due to the fact that everything becomes more expensive. We know the home prices is insane, crazy high compared to where it was 5 years ago. So with that being said, you always have to be making money with the money that you currently have, which is why sitting money in savings accounts is really not a good idea. Right? You have high yield savings accounts, right? If you want to put money from an emergency savings account perspective, put that into a high yield savings account. And I would say invest everything else. There should not be a time where you got a whole lot of money sitting in a bank account. At all times, it should be investing in a high yield savings account. You combine the two, you can always be making money on top of itself and always looking from a long-term perspective. All right. So that is the fundamental thing that we have to always be thinking about. Now, the second question is what to buy. And the lady said what to buy. And the guy basically talked about how most average Americans and new investors don't know what to buy. And we had this conversation about a week or two ago about, how you should go about doing things. I would always say you can start off with the total S&P 500. ETFs is always a great way to start. And then pick 3 great companies that you love. Again, ETFs, 2 ETFs, and 3 great companies that you love, right? The best companies in their sector, the top companies in the world, the companies that they'll be around for another 5 to 10 years. And you always look at the best companies in their sector that ultimately have the mind share of the majority of the people that you utilize that business or the service that the business provides. It's not as hard as you think, right? Everyone loves Amazon because Amazon's convenient. It has a moat. It has a psychological advantage on your mind. That's just why when people say, where am I going to go buy things from? Instantly, Amazon is one of the first things that you think about. Right. When it comes to this phone, right, one of the first things that people say is, are you going to get an iPhone or Android? Right. A lot of people utilize the iPhone. So Apple, being that they're the maker of the iPhone, would obviously benefit from that mind share, right? That moat. So how to invest and where to invest and what companies to invest is not as difficult as you think if you have the right mindset and the right tutelage and the right information. And then last but not least, I would always say you got to get yourself around a bunch of people or around a community of people that can speak to you about smart ways of investing, and learn as I always say, right? So the S&P 500, we talked about, how you can invest into the S&P 500. Surely I would say that the S&P has now become an AI fund. All right. Investing in the American stock market, the S&P 500 is one of the most popular ways that people grow wealth long term. Right. We have ETFs like VOO, VTI, and I always look at from a chart perspective, SPY. So has the S&P 500 become an AI company? That's the question. Because if it has, then is that a problem? Right? Because some people say the AI bubble is here and it's coming. So does that mean that stock market crash is coming ultimately afterwards? Let's go talk about the S&P 500 as a whole and if you should look to invest in it.
In a fund that follows the S&P 500, about 40% of your money is effectively tied to the performance of just 10 companies, most of which are deeply invested in AI development.
The S&P 500 is an index that is made up of publicly traded stocks of the 500 largest companies in the United States. And each one is given a weighting based off the market size of that company.
The S&P 500 is up more than 40% since October 2021, thanks largely to AI momentum. NVIDIA especially has seen massive gains in the past couple of years. It rose more than 230% in 2023 and 170% in 2024.
So how do we make money in the stock market? NVIDIA was up 230% in 2023, 170% in 2024. It is by far the number one stock in my portfolio, and we making tons and tons of money. This is how you make money in the stock market.
It's now more than 7% of the S&P 500. That means that one company now carries as much sway in the S&P as the bottom 224 stocks combined.
For many people, and I would say most investors in target date funds, a significant portion of your portfolio, particularly equity, is in the S&P 500.
I think investors have gotten so used to the idea that the S&P 500 is a relatively low-risk way to invest. And it's kind of obscured the fact that it's a technology mega cap fund today.
Others feel this bias toward tech and AI is an opportunity for investors to get ahead.
I think tech continues to lead the market higher, and that ultimately has really changed the game for investors.
So what does this concentration mean for the millions of Americans whose financial futures depend on the S&P 500? The S&P 500 is what's called a market cap weighted index. That means bigger companies have a bigger influence on how the index moves. Investors measure market capitalization by taking the number of shares a company has issued and multiplying it by its stock price. Therefore, if investors are driving up a stock's price, that can increase the company's market cap, which will then increase the company's weight in the S&P 500. That's one of the reasons why the S&P 500 has become so heavily driven by AI and tech giants.
Nearly half of the S&P market cap has medium to high exposure to AI, according to Citigroup's estimates. So what that means is that a lot of these companies in the index have put big bets on the emerging technology that's set to come out. The question is, will those bets pay off?
People are really optimistic about these companies, which is driving up the stock price, which is going to continuously increase the market capitalization, which will increase the market weight or the weighting in the S&P 500.
But because of the surge in AI enthusiasm, the S&P 500's performance now increasingly tracks a few very large tech stocks. The median stock in the index has risen less than the top performing tech stocks.
Over the last few years, the vast majority of the earnings and revenue growth that we've seen in the S&P 500 have come from tech and AI more specifically.
To some investors, that kind of concentration looks risky, but others see it as a sign of strength.
I think it's a great thing because right now the biggest asset in this U.S., when you think about across the country, it's Silicon Valley, it's AI, it's the arms race, that we're ahead of China. That's why you're seeing, even on S&P, the additions continue to be new tech, next gen versus maybe old legacy. And that's a positive as this continues to play out.
We have to get to a place where we understand where the United States is going and where the world as a whole is going over the next 10 to 20 years. And really, we're talking about a short timeline because 20 years is a long time. But if we just consider 5 years from now, we have Elon Musk talking about a robot army, right? And he's not talking about robot army in the sense that, you're going to war like, you're in Star Wars, but he's talking about a large amount of robots being able to now do work for instead of people, right? And we also have Amazon that just reported that they're going to ultimately lay off over 600,000 humans because they're now going to be replaced by robots and technology, right? So The other part of this conversation is the negative side and the drawdown that we could possibly see due to the technology. But in the end, we do know that over the next 5 to 10 years, there is a huge demand for artificial intelligence. There is a huge demand for more AI, more technology, robotics, autonomous driving, and a whole bunch of other things, quantum computing coming down the pike, which is then should tell you, hey, I should be investing in these things. I should be investing in the great companies that are going to make a difference when it comes to this technology and the continued dominance, world dominance that the United States is ultimately trying to have, right? So, yes, the best companies in the world, which is usually the top 3 to 5 companies in the United States, they are all driving this AI train. And I will say, if you haven't got on, get on, because we are continuously making money based on the fact that artificial intelligence, technology, and profits and growth is the momentum trade and has been over the last 2 years.
The idea behind the S&P 500 was to give investors a broad look at a much more diverse set of stocks to follow an index that way, whereas before you had the Dow Jones, which was just 30 names, obviously much more concentrated, a much smaller slice of the public markets.
So you've seen luminary investors like Warren Buffett of Berkshire Hathaway or John Bogle of Vanguard have touted the strategy of investing in the S&P 500 fund exclusively. If you set it and forget it and just buy and hold the index, you can make money over a long period of time and become rich. There have been ETFs and mutual funds that have started around the S&P 500, and the attraction there is that they mirror the index very closely, and they are low-cost funds that are passively managed so that you're really getting exposure to the big names in the stock market without paying a lot of money.
Investors will often strive for a diverse portfolio to ensure that one stock that has some sort of cataclysmic event that might cause the price to drop by 20, 30, 50% wouldn't have an outsized impact on the value of their portfolio. So having the diversification of the S&P 500, having allocations across 500 separate names, historically would provide for insurance against one name blowing up and having an overly negative impact on your portfolio value.
I think set it and forget it is no longer as applicable if your entire portfolio for retirement is in the S&P 500. Even regardless of what's happening in the AI market, it really isn't well diversified.
The top 5 companies alone in the S&P 500, NVIDIA, Microsoft, Apple, Google parent company Alphabet, and Amazon, represent nearly 30% of the index.
And so many people aren't aware how their retirement portfolio performance or taxable account portfolio performance is really dependent upon the success of these 5 companies.
The S&P 500 is still diverse for sure. You still have 500 names that make up the index. It is, however, much more concentrated than it has been throughout most of its history. There's probably some level of truth in calling the S&P 500 just a mega cap tech fund at this point. But when you look at the broader economy now, so much of that is tech and tech related. It's becoming something that is all encompassing. So having an index that is representative of our economy being so weighted toward tech and AI, you could actually argue makes a lot of sense.
But some see this concentration as an upside for investors.
You want the average investor to have more exposure to tech rather than less. I'd rather be owning tech in the left lane of Ferrari going 100 miles an hour than going 45 miles an hour in the right lane with value. Just think tech is where the growth is. That's where the asset values are going to continue to go higher. And you want to be more exposed to AI. And I think these indexes have really created that. We're living in a fourth industrial revolution. And I think the market is starting to reflect that. And it's an exciting time to be an investor in US tech. I think big tech's going to continue to lead this market higher. I think it will spread to mid cap and small cap, but I think it continues to be led by big cap tech.
1,000% agree. 1,000% agree. if you are not investing into the best companies, and we just looked at it, it spelled it out. It was, I believe it was 6 companies. It was Nvidia, Microsoft, Google, Amazon, believe possibly Tesla was on that list, and Apple was on that list for sure. Then you're missing out on the gains. You're missing out on the opportunities, right? Tech is the most important thing to the United States. It's the most important thing to the world. It's the war that we're having, not literally speaking, but the trade war and the technological war that we're having with China, as these two great powers try to, similar to the moon walking back in in distant history. Who wanted to get to the moon first? Who wanted to, in this time, have the artificial intelligence dominance and the quantum computing dominance in this world? This is where we are, right? So, being that we understand these things, it's very important that we invest in those things, because that's how we making money, right? The more earnings, the greater the growth. And we're going to talk earnings in a little bit next week as we start to have the big players. Quarter 3 earnings are next week for some of the biggest companies in the world, and you have to be tuned in and understand this is the most important aspect of this quarter and the continued growth to the end of this year in the stock market is going to be over the next couple of weeks. So invest, as I always say. And one company that we have invested in the past, I actually sold this company about a month or so ago, and I reallocated into some other things. But Netflix, right? Netflix is a great company. Definitely an amazing stock to own. It has done really well over the last few years. As you know, most Americans have Netflix. You subscribe to it. I know I do. I watch it every day. And Netflix is a great company. Their earnings did not do well this past week. I believe it was 2 days ago they had their earnings. And let's take a look at what happened with Netflix and if this is a possible buying opportunity currently right now.
A little bit of work to do here at 12 noon in the East, because we are red across the board. The Russell is today's biggest decliner out of the majors. It is the NASDAQ. Underwhelming. That's what they're saying about Netflix and the results. The stock's down a bunch. We'll take a look. So they had the Brazilian tax dispute, which is one of the issues. Core margins were above estimates. Record high engagement and viewership. They're all in on leveraging AI, they say in their note to shareholders. So I'll go to a shareholder. Joe Terranova, sitting next to me now. You buying this dip? What do you do?
All right, so here's the challenge with the stock. Fundamentally, when you hear the report, they hit on all of the metrics that you wanted to hear. We talked yesterday. I wanted to know, what's the plan with AI? Is it going to have the ability to reduce the spend on content, to lift margins? We talked about engagement, global engagement, needing to improve. It did that as well. Then you're throwing the curveball with Brazilian tax dispute. That curveball does not create the environment where you have the catalyst that was needed. We've talked about how the stock since June 30th really has been in a consolidation phase.
Let's show it, because it was after we at periods of time on this program, I have said something to the effect that this was one of the most, if not the most impressive stock in the market for a period of time.
Yes.
It did not go down, okay? I'm not talking about when it went from 700 to 400.
Right.
I'm talking about the resurgence that the stock had. Build it out further, and you'll see the run that I'm talking about, because it was an incredible stock. Even further, it was an incredible stock, which we talked about almost every day because so many people decided they were going to buy it on this program. And then it had this. There you go. And then it was, look at that move. I mean, it was pretty incredible. From that big drop down to that big run up, and then that sideways move more recently. Let's look at that now, as Joe was.
Before he goes into the side, I want everyone to pay attention to the chart, right? And this is why charting is very important when it comes to investing, right? If you pay attention, it's that yellow line is a 200-day moving average. So if you're looking at technicals, what I see consistently is that Netflix will come down at times, right? This looks like a 3-year. I think this may be a 3 or maybe a 5-year chart right now. We're looking 3 years out, 2023, a 2-year chart. So where we're looking at is Netflix, and the chart shows a consistency of price movement, historical price movement of it coming down and touching that 200-day moving average and bouncing back up. So if you are someone that's looking to invest in Netflix, this is, to me, not a bad time to get into it. Am I buying Netflix? No, it's not. It's not one of my 3 great companies that I love. I did have shares in the Netflix, and I sold out of those shares, and I bought more of the 3 great companies that I love. Right. So, it is an expensive stock, right? It is definitely an expensive stock. It's done amazingly well. If you pay it, look, I mean, just look at the chart. I mean, it was down in the 400s back a few years ago. It is now, 3x that. It was up as high as 1,300, I believe, is the high, around that 1,300 and some change range. Definitely a stock that will hit that $1,500 to $1,600 in a few years. It is an amazing company. Absolutely number one in the media space. No brainer, right? So if you are someone that's looking to possibly invest in it, I mean, listen, if it got to about 900, I would consider it. I would, right? I would consider it if it got under $1,000. But if you're looking at this chart, what it tells you is that Netflix at times gets volatile and it can come down at a large amount, pretty quickly. But it has been consistently moving in a direction upward like an escalator, and that is the type of stock that you want to own long term.
Was just talking about. Sorry, I just want to give some context for our viewers to understand the full story.
You have to tell the story of this stock because the journey has been remarkable. And up until June, the stock after today, it's not, but prior to today, it was outperforming the rest of the Mag 7. You needed a catalyst to get you out of the consolidation phase. You don't get that after yesterday's report. So now you ask the question, what do you do with the stock? Okay, here's the context that I'm working with, and I think Steven Surratt, you could respect this. The JOTI ETF takes a position in April of 2024, takes a position at 550. Okay, you could do the math, you could see what the gain is there. 1 month later, I take a personal position at 650. You could say that doesn't matter to where it is today, but it does because it gives me a degree of flexibility in terms of my positioning. What am I looking at? I am looking at the response to the 200-day moving average, which sits at 1113. It's the yellow line on the chart that we're showing. Earlier this morning, the stock went down to 1114. That's probably too perfect, Scott, that it held there. Probably too perfect. So what I am going to do over the coming days is I am going to see the reaction to this 200-day moving average. And despite what I might think fundamentally about the market, it is very clear to me right now that the market is working off some of the speculative excesses, and it's working off what has been a really strong year for momentum. And Netflix checks the box in terms of momentum. So in the next couple of days, I will reduce my personal holdings if this stock does not recover swiftly back towards 1150. If it stays here, kind of wallowing around 1100, 11 and a quarter, I'm overexposed at that point because I own it in JOTI, and I've actually owned this, as I've said, since May of 24 personally as well. All right.
This is why it's so important to invest in long term and from a long term perspective, right? He stated that he bought Netflix in 2024, and from his business perspective, he bought it for $550 a share. I don't know how many shares he bought, but I would imagine, and from a company perspective, from a business perspective, they bought a lot of shares, right? We're talking about millions of dollars of shares, or at least hundreds of thousands of dollars of shares, right? So he doubled his investment in a year. Doubled his investment in a year. There is not an investment that you can make that you're going to get 100% of your investment in a year. This is why investing in the stock market is so important, Because and sure, his money might be a little different. His business money might be a little different than the average person that might be listening to this. But understand, even it's $100. Hey, your 100 went to 200, right? Your 1,000 went to 2,000. That's significant, right? And investing in great companies is why we don't invest in penny stocks, and we're not doing that way. We're investing into the best companies in the world. But let's get back to what he was saying. Right, he's looking at the 200-day moving average as his guide on if he wants to either sell or get out or he reinvests, etc. Right, if you are owning Netflix and depending on your cost per share, depending on when you got in, and depending on if you believe in the stock long term, you believe in the company, which you should. This is obviously a buying opportunity. It's obviously a buy. Now, when do you buy it is very important. This is why it's important. Again, it's not just understanding what to buy, but also when. Looking at the chart, she's looking at the 200-day moving average. I gave a price just a short amount ago that if it hit this price, I would get into it. It just depends on your investment strategy and ultimately what you believe and how much you believe in the company. There's certain companies like Nvidia, for example, that if it came down to 160, I'm buying as much as I possibly can. Right, it's at 183, 184 today. Every time it comes into 170s, I'm buying more shares. If it hits down to 160 or lower, I'm loading the boat. I'm trying to figure out how much money I can actually put into it because I love the stock. So as an investor, it's important. If you love the stock, look at the opportunities when they come. Sometimes earnings come. Don't overreact to the downside. Look at it from an opportunity perspective and get into it at a price that you like and ultimately want to invest in the stock. So Netflix currently right now, let's look at Netflix currently at the moment. And let's see what it closed at the end of Friday, end of today. So Netflix, because this was about a day or two ago when Netflix earnings hit. All right, Netflix is at $11.13, so $1,100.13. The 200-day moving average is around 11.15, so it actually closed. Actually, I'm sorry, Netflix. Netflix is at 10.94. 10.94. So it went under it went under the 200-day moving average, and that's important because then you need to then take a look at what is the historical movement of Netflix when it gets under that 200-day moving average. Also looking at what's about to happen next week when it comes to the Fed. It's very important to understand that. And we're about to get into CPI currently right now, but always understand the macro and the micro dynamics that comes into the stock market, how, events and things like that affect the market as a whole. You take all of those things in consideration when it comes to if you love the company and buying it. I'll say at 10.94, you consider starting to nibble at Netflix. And again, I said if it get under that $1,000 mark, I might have to get back into the stock long term. But today we had CPI report that absolutely did the business when it came to the market. Right, we had volatility over the last couple of weeks. CPI today was much needed for the stock market. It definitely helped cool down some of the fears, and the market hit an all-time high today. So let's look at the CPI report and see how that affected the market as a whole.
Didn't tell you that is at the CME. You're excited, Rick?
Yeah, excited isn't the word. The market should be excited too. Here's our late but coming out September read on the Consumer Price Index. Headline number up 0.3, 1/10 cooler than both rearview mirror and what we were expecting. And if we look at the stripping out of food and energy known as core, it comes in also a bit less than expected, up 0.2. We were expecting up 0.3. Our last look was up 0.3. Here's the Moneyball numbers. Year over year, 3%. And even though it's less than the 3.1 we were expecting, it's hotter than 2.9. And after all, it's got a 3 handle. And if we look at CPI year over year ex food and energy, it also comes in at 3%. We were also expecting 3.1, but last look was 3.1, so it cooled a bit. So we're seeing interest rates move down and stocks move up. You may be asking why. The easy answer, because it's less than expectations. Is it less than the Fed's target of 2%? No. Which, in my opinion, that fact will rise above all the issues of the day at some point. But yes, we do see rates moving a bit lower. Ultimately, this is a very important number because the market, without any data points, has been pretty much viewed on the notion that the labor market is slowing, and that really is a good thing if you're looking for the Fed cycle to continue its rate cuts. Now, how does this figure in? I can't speak for Fed officials, but if you really have an agnostic view and you look at these numbers, the last thing you think about is we're closing in on the Fed's target. Joe and the gang, back to you.
In a nutshell, that's exactly what people said leading up to this, Rick. It's going to be higher inflation, but it's not going to be high enough to cause the Fed to change any of its plans. And that's what, and we saw some even better. Even if it was 3-1, I think that would have been the case. But even a 10th, I mean, these aren't huge moves, but definitely saw an uptick.
This was one of the most important reports that we have had this fall. And it has everything to do with the government shutdown and how we have not received many reports over the last month due to the government shutdown, which has caused uneasiness in the markets, right? When it comes to the Fed, right? And if they were going to continue the lowering of interest rates, right? So the CPI report today really kind of guaranteed a Fed cut next week. It put it in a place where you can almost book it. So the stocks soared. Stocks absolutely went crazy. Some stocks hit 52-week highs. S&P 500 definitely hit a high. And let's continue with the CPI report and what that means for the Federal Reserve next week, the Federal Reserve meeting, and we will be live on YouTube during that Federal Reserve press conference. But let's take a look at next week and how important that is and why this report really kind of solidified the possibility that the Fed will be lowering interest rates next week.
Richard Bernstein Advisors Deputy Chief Investment Officer David Seif. Nomura, Chief Economist for Developed Markets. All right, gentlemen, who wants to start? So this is probably, David, this is probably about what you were expecting, is it not?
Yeah, it's even a little bit softer. And so that's great news for the Fed in terms of their ability to cut in October, which didn't really seem that much in doubt, but also to follow the dot plot in December. You've had some people on the Fed who are on the more hawkish side of things who've since September pushed back on what seemed like a dovish shift. And of course, we haven't gotten very much data since then, of course, but what little data we do have now from just now does appear to make it seem like inflation fears are at least a little bit, we're a little bit too high given what we're getting in so far.
So the market has been strong, Michael, and Rick makes that point. Any AI tailwind that makes it less fundamentally based than we think?
No, I think, listen, fundamentals, Joe, are pretty strong right now, and there's no doubt about it. You know, the economy is not weak per se. I mean, you've had pockets of weakening. I really do believe we're in a K-shaped economy where the lower end is maybe not quite as strong as the higher end. Today's number for me is actually about broadening more than it is about AI, although probably the first step forward is going to be more about AI and some of the momentum plays, just because they are juiced by liquidity and we do have easy financial conditions, and this will sort of pretend more of that. But, you know, I think you can make an argument that you get some broadening here, and it's not just about AI.
Yeah. I mean, it is kind of, you know, latest is, Rick, we're not talking to Canada at all. We're so mad that you did an unedited or an edited version of Ronald Reagan, and 2 weeks ago it was 100% tariffs on China, and all the market's done really is shrug that off and head higher.
Well, is it shrugging it off, or is it going along with the notion that it believes the president and the administration will use their strange style but come up ultimately successful? Listen, I don't think the administration's necessarily bluffing. I think what the market's concentrating on is that Canada needs the U.S. more than the U.S. needs more than Canada. China needs U.S. more than the U.S. needs China. That's what I think the markets are focusing on, and not so much all the issues with Trump that the media seems to focus on more directly.
So what's important in this conversation is the understanding that stock market is as what, you know, Ian Dunlap will say, the master investor. He'll say the stock market is rigged to go up. The stock market is rigged to go up. There's so much money into the stock market. It's billions and trillions of dollars into the market that is ultimately rigged to go higher at all times, right? Regardless of what's going on around the world, regardless of the hiccups that we have at times, right? There is always a reason why the stock market continues to go up. So if you are an investor and we see these volatile red days, and you look at the day, the week, the month chart, and you looking at these opportunities at these the bottom end of a V or the bottom end of a W in the chart, it is definitely an opportunity to invest in the stock market. And right now we're going to talk about all-time highs as we have reached today in the S&P 500 due to the CPI report. How do we invest in the time that we are at an all-time high? That's the question, right? If you're a new investor right now, you're saying, "Oh, Antoine, I want to buy some stocks. I don't know what price I should be getting in at." This is how we start strategizing and seeing how we should be investing. If we missed out on a dip, if you missed out on one of those volatile dips that happened over the last couple of weeks, if you missed out on April of this year when tariffs was hit on the world and Donald Trump, you know, crashed the market for about a week or two, you still can invest, but you have to be strategic. Normally, you do not want to buy at highs. You don't want to buy any stock at a high. I'm going to repeat this again. You do not want to buy any stock at a high. You want to wait for a pullback. There is always opportunities that come. You just have to be ready for it when it comes. So let's look at all-time highs in the stock market and ultimately how we should be investing right now.
You know about the mega caps. 5 of the 7 are reporting. Jensen Huang gives a keynote on Tuesday. The Fed decision is on Wednesday. The meeting between the presidents, Xi.
And as we look at this is important. Earnings next week. We have to be aware of the big tech earnings next week. As you can see right now, we have Alphabet, Meta, Microsoft, Amazon, and Apple all reporting next week, as well as we have the Fed decision on Wednesday. Again, we will be live with the Fed for the Federal Reserve decision press conference on Wednesday, as we continue to give you all information on it on this channel, in this show, ultimately Financial Blueprint. But it's important that we understand earnings, we understand companies, and we understand that the companies that we invested in.
And President Trump, of course, on Thursday. So we got a lot to look forward to. Weiss, I think it's interesting that this market looks at CPI cooler. It's convinced the Fed's going to be engaged, and highly so. It has a ticket to cut, and a ticket to cut multiple times. Your move the other day of either trimming or selling out of Alphabet, as you expressed it, was in part, as you said, to take down your exposure a little bit. This market doesn't seem like it wants to go down.
Yeah, and I should have been clear. Take down my exposure in the assets that basically all have the same end game, which is cloud, which is AI. So I've got large positions, and I haven't sold all of Alphabet yet. I'm probably going to sell it into the earnings and wait for more of a run. So I'm concerned about search. But I've got large positions in Microsoft, in Meta, in Taiwan Semi. Not as large a position anymore in Netflix, which is separate. And they're all playing the same things. They all trade alike. I don't need that exposure.
I know, but you were a little bit cautious the other day in the overall market.
And I still am.
Yeah. Why so?
Well, I just think that at this point, the Fed cut is in the market. A couple of Fed cuts are in the market.
Is it? How is that possible given the move today?
Well, we'll see when they actually do it. I think that today was the answer is, Scott, these moves perplex me because you discount the news once, which got us to the level before today. Then you discount the news again when you get news like today, which it was better than expectations, frankly. But 3% inflation is still way above the Fed target. But this continues to be a half full market. but the risk is in some of those names, not long-term risk, but valuation risk, price risk in some of those names I have. So I have been cutting back. So I have more cash than I've had before, but still, it's about 3-4% cash position. So it's not.
All right, who wants the other side of that? Go ahead.
Before we get started on the other side of that, I would totally disagree with the gentleman. I would disagree with his stance that we have already baked in two Federal Reserve cuts and we're at a high in the stock market. I disagree. And one of the reasons why I disagree is because today a gentleman actually sent me a message and he said, "Hey, look at the fear and greed index." Right. And look at the fact that the S&P is at an all-time high. So I went and looked at the fear and greed index. This is one of the things that you can use to look at the market as a whole. And if the stock market is at a, overinflated standpoint, the fear and greed index is definitely something that you can take a look at. Right now, the fear and greed index is currently at a 33, which is in the fear category. So he basically asked me, "Hey, how is the S&P 500 at an all-time high, but the fear and greed index is at a fear level, which is 33?" And if you are ever paying attention to the fear and greed index, and if we ever get under 20 to where we are at that 15 to 10 level, that is the time to buy stocks. And if we can go back and look at what the fear and greed index was in April, it was in that 10 to 15 range when the stock market went down significantly due to the Trump tariffs. So the fear and greed index can definitely help you when it comes to, if you want to look at something that's going to tell you if we are at a overinflated stock market level or if we are at a level where it's more neutral. You always want to buy into fear, and you want to sell from a greed. So when the market goes up, the greed of the market goes up, FOMO happens. So many people want to invest in the stock market. Then we get to a greedy level. And usually when we get to that extreme greed level, that's when you see a correction or some type of downturn happen. So the fact that we are sitting at a 33 as of today, which is sitting in the fear category, that tells me sentiment is not that well currently to say that we are at a level where we are at a high and we should be a little bit concerned. Right? I'm not just looking at the fear and greed index. I'm also looking at PE ratios of companies. We have to take a look at earnings next week when it comes to these tech companies to see what their earnings forecasts are for the next year. Right? We have to take a look at multiple things, but to say that we are at a high from a market perspective, yeah, I disagree totally. Disagree.
Yeah, I think valuations are a tough timing tool. I think Steve would agree with that.
Yep.
I think we have rate cuts. We have meetings with Xi next week. We have earnings that have come in positive. We have earnings revisions that are headed higher. We have positioning that has moved back decidedly to neutral or slightly under. And so from our lens, the chase is on until the end of the year. We have a lot of liquidity in the markets. You're looking at cash building. You're looking at positioning in gold building, which could arguably be a catalyst given the performance of gold of late to get investors back engaged in traditional equities. And so while I think Steve's right to be mindful of valuation, I think there's other things that are happening right now that are pressing the market higher.
I mean, the market doesn't seem to care at all about President Trump's tariff whims or anything because the economy's good, earnings are good, and the Fed's going to cut.
Be great.
The Fed's going to cut a bunch.
Right. So just so I'm clear, I'm not bearish, right? I'm repositioning. So we'll talk about a move I made before.
Yeah, we have a lot of moves to get to today.
And,
we will.
And that's why I've raised some cash because I want to diversify the portfolio. Number one, as I did with Cat earlier this year, which has worked out to about 40%. And I'm looking to do that further when I can go bargain hunting. So that's why I won't have the cash. I don't want to have to sell at a particular point in time. And I am concerned about alphabet search.
I mean, it's funny. Those who were looking for a pullback, you had private credit bubble up and people got a little bearish around that. and other, issues that were out there, what's going on between the U.S. and China. People got a little bearish about that. And then here we are at new record highs. The market seems to brush it off. Those who are looking to find bargains or have an opportunity to buy lower haven't really had the opportunity unless they were as nimble could ever be.
As Warren Buffett said, it's not timing the market. It is about time in the market. We just went over this, I believe, last week. It's not about timing the market. It's about time in the market. You have to be invested in the market for a longer period of time for you to see the growth and see the gains that we're talking about. Right. And when we're listening to some of the analysts and they're speaking about selling and things like that, understand every time you sell a position, you got to pay taxes. And we're not going to have a tax conversation per se right now, but understand every time you sell a position, you got to pay capital gains tax. And a little homework assignment is go and look at what your capital gains tax is per your tax rate. How much money you make. See what the capital gains tax is, short term and long term. Right? Under a year is short-term gains tax. Over a year is long-term gain tax. Make sure that you understand the consequences of selling stocks every day, right? These short-term traders selling and buying on a daily basis. The tax side of it is substantial. It's insane. So it's better to hold long-term. It's better to stay invested. It's better to continue to add shares when dips come, when opportunities come. And get out of this thought process that, every 2 or 3 months we selling stocks. No, we're not. No, we're not. The only reason why I sold Netflix and some of the other companies is because I wanted to trim my portfolio down. I was too stretched. So I said to myself, okay, let me trim this down to 5 companies that I love. It's really 4, and then one infrastructure AI play that we talked about ultimately last week, right? So I have 4 great companies that I love and a few ETFs, and then we have long-term leaps and trades out to 2027, and we just continuing to allow the stock market to continue to make us a ton of money, right? So this is why it's important for you to be invested long-term so that you don't have to worry about, getting in, getting out, and earnings and all of that type of stuff. Earnings next week about to be nice. It's about to be amazing. These companies, when it comes to their AI plays, when it comes to their infrastructure, CapEx, when it comes to their investments, their growth, Google, Meta, Microsoft, these earnings, Apple next week, it's going to be an amazing week going into the stock market. And then you add that in with the Federal Reserve lowering interest rates. We looking at really nice gains next week into Nvidia in a few weeks, and ultimately to end the year in the fourth quarter.
You can't fight this. I mean, I hate the trite sayings that I've been saying for the past couple of weeks, like don't fight the Fed, don't fight the trend. You just got to believe in it. Look at the price action. And by the way, Steve, I understand and agree with your perplexity, to use that word that you used. I'm just simply observing that anytime the market goes down, it doesn't even get 2% down off the high before it gets bought. And I'm not justifying it. I'm saying that's what's happening. If I try to explain it, what I say is there's a lot of cash on the sidelines.
You don't have to feel bad to justify. I mean, you have to put a disclaimer out.
No, the reason I'm doing that is because I understand where Steve's coming from. You look at this and you do say, isn't this already priced into the market? But that sort of analysis, the analysis that we all like to do, just doesn't matter. This is a trend is your friend sort of market. And you see it in how much cash comes into the market on the slightest dip, whether it's retail and money market funds, whether it's professional money managers trying to catch up to the benchmark. It just is what it is. Another trite saying. Now, there is justification. And Rob said it, with rate cuts coming, deregulation. And you know what? If you do get a China-U.S. trade deal, we go higher on it. That's just where we are.
Macroeconomics. I mean, we got too many reasons, right? Federal Reserve cut, earnings good. He just mentioned the United States and China deal. I'm telling you, when Trump tweets, when he puts on Truth Social that the United States and China has agreed to a trade deal, it's going to be bananas for the stock market. Because all this year we've been talking about China, United States, chips, semiconductors, artificial intelligence. We have had this conversation over and over and over again. The market went down about a week or two ago because China stopped allowing Nvidia to trade to buy, to sell chips into the country. Right? We've had all of these conversations about tariffs and this tariff on this country, this tariff on that country, tariff on goods, tariff on chips, all of this stuff. When it's announced, because it's going to happen. Right, it's going to happen. The stock market is going to go crazy. On top of the fact that earnings is about to be great, forecast into 2026 is about to be great for the majority of all the tech companies. Intel just reported 24 hours ago, and their stock went up 10% in one day. And that's Intel. And no shots at Intel, but Intel isn't Nvidia. Intel isn't Microsoft. Intel isn't some of the best companies in the world. It's important that we know the macro and micro dynamics that's ultimately going to lead to the stock market continue to move forward. So all of this talk about bubble bursting and stock market crash, it ain't happening no time soon. It's not happening over the next 3 months easily. To end the year right now, we need to be looking at, okay, how high can the S&P 500 go? 7,000, as Tom Lee said. Can we hit 7,000? I'm looking at the chart and I'm seeing the possibility of it going. Yeah, it could possibly hit 7,000 in the year. It could possibly hit 7,000 in the year. What is stocks like Nvidia doing and Microsoft is going to do and Google and all of these other great companies? It's a possibility that all of these great companies do extremely well over the next 2 months to end the year of 2025. So you should be invested. As I always say, invest. You should be invested in the stock market. Let me just tell you, and this is not, just in one of the accounts, we got over $1,300 of gains today. I haven't done it. I didn't even touch the account. And I'm not someone that got hundreds of thousands of dollars invested in the stock market, but today was a great day in the market. And I'm looking forward to some more days like this. And I'm not selling a thing. And I'm looking forward to ultimately what the gains look like over the next year and ultimately in the years to come.
We'll worry about this in January, but right now the trend is your friend.
Yeah, allow me to remove the perplexity because you're asking, why is the stock market up today if we've already baked this in? And I think we baked in a rate cut for sure next week. But today gives a green light for another cut in December. And well, to your point, Scott, more cuts next year. I'll make the case that this could be the last three handle we see on CPI. I think inflation could be coming down even lower. And this is all the reason why we're seeing the move today. Plus, next week, we get all these earnings reports, especially with the Mag 7. I just think that there's so much enthusiasm behind this market today, specifically for good reason.
There are those who are thinking, that 3% is the new 2%.
Well, I'm going to tell you
it's
something.
Not going to prohibit the Fed from going.
Shelter is a very important component. That's what you saw today. You said goods inflation, but shelter deflation. Shelter makes up a disproportionate portion of the CPI, and it's going to be in a downward trend for a while. And then you have interest rates coming lower, which is going to spur building activity, which should also ultimately be, from a price standpoint, deflationary, even though it'll stimulate economic activity. And so I think the inflation story, I don't want to say it's dead, but it's at least put behind us for a while because the tariffs aren't hitting the key goods like gasoline prices because they're exempt from things like that. And so what ends up happening is goods inflation is really just hitting the high end of the market, which can completely tolerate it because they own the Nvidias, they own everything that matters. So they're ignoring it. And in the consumer economy, which really reacts to rents, right? And gas prices, you're seeing them not react to it either. And so it gets back to this situation where you can continue to have this momentum.
Very big.
1,000% agree, as I stated before. I'm not worried about evaluations currently at the moment, especially, again, I'm not talking about every company in the United States stock market. I'm talking about the companies the 3 to 5 great companies that I'm investing in that ultimately are going to drive earnings and continue to provide amazing growth over the next year or so. Right? PE ratios is not going up, they're going down due to earnings, right? The Federal Reserve is lowering interest rates. I just seen a report that Ukraine and Russia, Trump is trying to work a peace deal when it comes to those countries. I mean, when that happens, that's going to be a catalyst to the upside, right? We all know about China and the United States trade, war situation they got going on right now and the disagreements that they have about different things. When that gets figured out, because it will, when that gets figured out, there's going to be another catalyst to the upside for the stock market. This is not a time to sell stocks. The prices of stocks have gone up significantly over the last 12 months, especially since April of this year. This is not the time to sell stocks. This is not the time to sell stocks. Right? So, stay invested. If you need to walk away, right? Walk away from your computer, walk away from your phone. Don't turn it on every day to look at how much you made, and you're thinking about selling because you're looking at the gains and you're like, I want to sell. But hey, when you sell, you got to pay the government taxes. We're not trying to do that. We're trying to stay away from taxes, right? So what we are seeing is rates is coming down, and we have some movement in the market, in the housing market, and we're going to get more into real estate over the next 3 to 6 months as I move forward with buying another house, possibly building another house, building a new house. We're gonna take you into the day-to-day when it comes into the real estate game, right? I am a real estate investor, by the way. I do have rental property. Looking to get more rental properties over the the years to come, right? So what lowering rates is doing is giving the housing market possibly a boost in the future, right? You have the opportunity to get a lower rate if you have a mortgage. If you bought a house over the last 12 months or so, rates have come down a little bit, and they will continue to come down. So this is a good time to start dabbling into the real estate market. But we have a report about the current housing market, and we're going to see what the current report is from the report we received this week for the housing market.
Look at the good, the bad, and the instructive in the housing market. Our senior real estate correspondent, Diana Olick, joins us with the results of CNBC's housing market survey. Diana, good morning.
Good morning, Becky. Now, this is something of a sidewalk survey. Each quarter, we'll ask real estate agents from across the country and in a cross-section of neighborhoods just what they're seeing on the ground. Now, here are some of the highlights from Q3, when the average rate on the 30-year fixed mortgage was mostly on the decline, but moved up mid-September. Now, during that time, 49% of real estate agents we surveyed said it was a buyer's market, meaning that buyers had the advantage because homes weren't selling quickly and supply was sufficient. 30% saw it balanced, and just around 21% saw sellers with the advantage. As for prices, 44% said they saw them declining, 38% stable, and just 20% increasing. Now, again, all real estate is local, and market fundamentals are therefore different based on location, of course. Still, the trend is definitely for lower prices. And 89% of our agents reporting having at least one seller who decided to cut their price last quarter. That really shows how kind of over-optimistic sellers still seem to be, despite all the uncertainty in the economy and a slowing housing market. Now, even more drastic, 40% of agents represented sellers who delisted their homes due to those rough market conditions. So what will we see this quarter? Well, 48% of agents expect the market to improve, and 35% think it'll stay the same. Just 17% expect sales to decline. Now, this is just a few pieces of this housing market survey. You can read all of the results, much more, many more insights on CNBC.com. It's posted right now. Back.
So the housing market, and this is Q3, right? So we're talking about the summer months. And it ended Q3 or ended in September. So I'm sorry. September. So this is, older when interest rates were higher. So we have definitely seen some issues with real estate, with higher rates. It basically means that no one's going to buy a house. You got high interest rates, especially if you have a house currently that and you're trying to upgrade, and you have a lower interest rate, like myself, we have a low interest rate, so it doesn't benefit us to leave the house that we currently live in currently right now, or over the last couple years, due to the lower interest rate, right? And then the higher interest rates, as well as higher prices, home prices. It doesn't provide a great environment to try to go buy a new house, right? So that has caused definitely issues in the housing market. But as we know, we have witnessed the rates start to come down. Interest rates are starting to come down, and the Federal Reserve is continuing to work the federal rates, and we will continue to see lower rates in the future, right? So for me, I am looking to buy another house next year, and as rates continue to come down over the next 6 months or so, we're looking into possibly buying a new house or possibly building a new house, right? So one of the reasons why I say invest is because you can utilize, your investment account for different ways, right? So one of the strategies that I utilize is I invest a lot of money into the stock market, and then when I get to a certain place in my fund, I possibly think about buying another real estate property, and I reinvest that money into real estate, and I rinse and repeat and do the same thing over and over again. So one of the ways that we can grow money is utilizing the stock market. And one of the ways that we can invest is in the market as well as into real estate, right? So I, again, recommend that you continue to invest in the stock market. We went over today how the stock market has reached all-time highs. We went over Netflix. Is Netflix a buying opportunity currently right now? It is sitting at 1094 at the end of today's trading session, right? So Monday, is that an opportunity for you to buy into Netflix, right? Take the information, take the earnings, look at the history of the stock, maybe possibly look at the chart and see if that's something that you want to invest in, right? We talked about the government shutdown and how day 24 is today, and how it has been terrible for families, for Americans, federal workers, as well as military and people that ultimately are affected by programs that are federally funded. We know and talk about how SNAP benefits are ending November 1st in certain states, right? It's important to look at your state that you currently are living in, because they are finding ways to, continue the SNAP benefits. I believe it's the state of New Jersey just announced that the governor put a state of emergency, and basically the state SNAP program has been moved to be state funded instead of federally funded until the government shutdown is lifted. So New Jersey, I believe New Jersey is one of those states that SNAP benefits will continue. It's important to, look at your statewide information, depending on where you live. You might have some programs that might end in about a week, and some programs that might not end depending on what state that you're in, right? So this time we have right now, we got government shutdowns happening. We got stocks at all-time highs. If you're an investor, it's a great time to be an investor in the stock market. I will always say invest. And I'm going to leave y'all with this. I woke up this morning. I wasn't necessarily feeling that great. A little tired, but I went to the gym, as I always do, and had a great workout. Did my leg day this morning, but as I was working out and I'm sitting there, I'm on a bike and I'm doing my thing to warm up, get myself ready to go. And the only thing that can come to my mind is like the consistency is required to be great. You got to push through the times that you might not feel like doing something, and be as consistent as you possibly can and disciplined when it comes to your decision making and how you go about handling your business. And sure, this is an investment channel. We talk about the stock market a lot, and we talk about money. We talk about a lot of things when it comes to financial, education. But it's important that this part of the conversation is key. Your consistency and your level of discipline that you have when it comes to making money decisions, when it comes to being consistent in your finances, when it comes to you getting paid today. Some of y'all got paid today. What are you doing with your money? What are you doing with your money? Another $1,500 went into the brokerage account. today, right? And every time we receive something, we invest in we're investing in a large amount of it. We are continuing to be disciplined. We are continuing to be consistent and executing at a high level with the consistency and discipline will allow you to propel yourself in a positive direction in your work life, in your personal life, in your investment life, and ultimately long term in your successful journey when it comes to life in general. But on this channel, we talking about the money right now. Be consistent, be disciplined when it comes to your money, and make sure that you put it to work in a positive way with great companies for a long-term perspective. Right? As Ian Dunlap will say, and master investor, if you can long-term invest and learn how to trade, and then possibly do the more advanced futures and things like that, you can propel yourself in a positive direction in a massive amount. But first and foremost, when it comes to investing, we want to be long-term investors. So I love you guys. I appreciate y'all. Antoine Small's Financial Blueprint. Every Friday, we out here on the stock market live, continuing to give you the information, looking at next week, the news from the week, and also giving you some recommendations on how you can grow your portfolio and ultimately what you should be invested in over a long period of time. Next week, again, earnings next week. We got the federal rate cut. Tap in with me on Wednesday as we go through the Federal Reserve chair meeting, and we talk about how the stock market has reacted to that meeting and ultimately the lowering of interest rates. I love you guys. I appreciate y'all, man. Hit the subscribe button, like the video, hit the like button, subscribe, share this content when someone needs to hear it. This is so important now as we continue to progress in our financial journey and ultimately your future. Everybody, and I repeat, everybody should be invested in the market. Everybody should be looking at assets, growing our assets, lower your liabilities, pay off your debt, and continue to progress yourself and your family, and ultimately, hopefully, your children for their future as we continue to progress in our financial journey. I love you guys. I appreciate y'all. I'm out. Antoine Small's Financial Blueprint. Peace.